Have you ever been caught in the battle between order blocks and the Fibonacci Golden Zone? If you're a trader, chances are you've asked yourself, which one should I trust more? In today's video, we're diving deep into this common dilemma that leaves so many traders scratching their heads and losing trades. Stick around because by the end, you'll know when to trust an order block, when the Fibonacci Golden Zone takes the lead, and how to use both like a pro. Let's settle this once and for all. Before we dive deep into these two concepts, we need to remind each other how to identify each one in the market. There are three main principles to identify a valid order block, which we always discuss on this channel. Firstly, the order block must be unmitigated, meaning it must not be retested by the wicks of subsequent candles. Secondly, the order block must lead to an imbalance. An imbalance is seen as the gap between the wicks of the first and third candle. Lastly, it must lead to a break of structure, which signals that the overall market momentum is still in that direction, making it safe to look for further trading opportunities. On the other hand, a Fibonacci Golden Zone is described differently by other traders, but from my trading experience, the Golden Zone is the area between the 61.8% and 78.6% levels. Now that we've refreshed our understanding, let's address the big question: which one is better, order blocks or the Fibonacci Golden Zone? The truth is, neither is better than the other. Both are incredibly powerful tools, but their effectiveness depends entirely on how and when you use them. That's exactly what we'll be covering next: how to master both strategies and know which one to rely on in different market conditions. So, stick around until the end because this insight could take your trading game to the next level. Let's start comparing these two concepts by breaking them down across timeframes, because they behave very differently on the higher timeframe versus the lower timeframe. On the higher timeframe, we will only use order blocks, not the Fibonacci Golden Zone. We use order blocks to identify key higher timeframe zones that might influence price movement on the lower timeframe. Now, you might be wondering, why don't we use the Fibonacci Golden Zone on the higher timeframe? Well, there's a reason for that. Let's take a look at this price chart example to illustrate the differences and effectiveness of each on the higher timeframe. In this higher timeframe example, if we were to identify a valid order block, it would be this one. However, since this is the higher timeframe, this zone is too big to be tradable, meaning you would be risking a significant amount of money if you execute a trade directly in this zone. But here's the advantage of using an order block: you can transition to a lower timeframe and refine the zone, making it smaller and more reliable. This refinement allows you to risk less per trade while still taking advantage of the higher timeframe's influence. Now, going back to the higher timeframe, had we used the Fibonacci Golden Zone instead, even if we transition to the lower timeframe, we wouldn't be able to refine the zone effectively. This makes the Fibonacci Golden Zone less reliable on higher timeframes. This is one of the reasons why order blocks edge out the Fibonacci Golden Zone on higher timeframes. Additionally, the Fibonacci tool tends to be less accurate when applied to higher timeframes. So, from this point, it's clear that on higher timeframes, we will only use order blocks to identify key zones that can significantly influence price movements on the lower timeframe. Now that we're done with the higher timeframe, let's shift our focus to the lower timeframe. On lower timeframes, we can use both the order block and the Fibonacci Golden Zone, but their effectiveness depends on the specific market conditions. Let's start with the order block. Order blocks are much more effective when trading during pullbacks. Let's look at a price chart example for a more concise explanation. In this example, we see a break above the previous high, signaling that the overall market momentum is still bullish. However, the market has now entered a phase of exhaustion, which means we are anticipating a pullback. To capitalize on this pullback, we shift our attention to the internal market structure. By transitioning to a smaller time frame for a clearer perspective, we wait for the price to take out this local swing low. A takeout of this low would confirm the start of the pullback, meaning we should start looking for short-term selling opportunities. So, which one is better to trade from during a pullback, the Fibonacci Golden Zone or an order block? In this case, the most accurate answer is an order block. Here's why: during a pullback in a bullish market, the price tends to push up to extreme demand zones. From there, you execute your sell orders, and price is likely to drop, hitting your target. Now, had we used the Fibonacci Golden Zone during this pullback, it's clear from this example that we would have been taken out of the trade. This demonstrates that during a pullback, the order block is more reliable, whereas the Fibonacci Golden Zone is less effective. Now that we know when to use the order block, let's shift our focus to the Fibonacci Golden Zone. So, when is the appropriate time to use this tool? The Fibonacci Golden Zone is much more effective when trading continuation setups. Let's look at a price chart example for a clearer explanation. In this example, we see a break above the previous high, indicating that the overall market momentum is bullish. Price then pulled back to retest this demand zone, presenting us with an opportunity to go long. However, since this is a higher timeframe demand zone, we don't execute buy orders here directly. Instead, we transition to a smaller timeframe for extra confirmation. On the smaller timeframe, we wait for price to take out this local swing high. A break above this high signals the end of the pullback, confirming that it's time to look for long opportunities. Since this is a continuation setup, we will use the Fibonacci Golden Zone to execute our buy orders. This works because we're within the discount pricing range, where buyers are stepping in and preventing price from reaching any extreme demand zone. The price will likely drop to the golden zone, giving us a perfect opportunity to buy, and from there, the price will push up and hit our target. Had we chosen to rely on an order block for this setup, we likely would have missed this trade, as price didn't reach any extreme demand zone. This confirms that for continuation setups, the Fibonacci Golden Zone is the better tool to use, especially with lower timeframe confirmations. That's all the basics you need to know about order blocks and the Fibonacci Golden Zone. While each tool has its strengths and specific conditions where it excels, they both serve as powerful strategies when used appropriately. However, we're not done yet. One thing I really like about these tools is that they can act as confluences of each other, improving the likelihood of a successful trade. Let's dive into more price chart examples to see how these tools can work together. In this price chart example, price broke above the previous high, clearly indicating that buyers are in control. Price then pulled back to retest this extreme higher timeframe demand zone, presenting us with a great opportunity to go long. However, remember, we do not execute any orders directly on the higher timeframe. Instead, we shift our focus to the internal structure for extra confirmation. Next, we transition to a smaller timeframe, where price took out the local swing high, signaling the end of the pullback. From here, we identify our lower timeframe demand zone to trade from. But here's the exciting part, this demand zone aligns perfectly with the Fibonacci Golden Zone, creating a powerful confluence that significantly increases the probability of success for this setup. We wait for price to pull back and retest both the demand zone and the Fibonacci Golden Zone, then we execute our buy orders. Be sure to place your stop loss just below the order block to manage risk effectively. Price will likely respond impulsively, shooting up and hitting your target. Notice how these big bullish candles indicate high buying volume in the market, confirming the strength of our setup. Always be on the lookout for these kinds of setups, they can significantly transform your trading game. Let's do a quick recap of the key concepts and principles we've covered so far. The main takeaways are: on the smaller time frame, when trading a pullback, we use order blocks because they are more reliable in these market conditions. On the other hand, when trading a continuation setup, the Fibonacci Golden Zone is the better choice, as it works best in these scenarios. However, it's important to note that it's very rare for the market to offer both pullback and continuation setups within a single three-phase run. Most of the time, you'll only encounter one of the two. That's why it's crucial to capitalize on what the market gives you by applying the appropriate strategy we've discussed in this video. Now, let's look at a price chart example to tie everything together and conclude what we've covered so far. In this example, we observed a break above the previous high, signaling that buyers are in control of the market. We then identified an extreme demand zone as a potential area for buying opportunities. Anticipating a pullback, our focus shifted to capturing short-term sell opportunities during the retracement. Transitioning to the lower time frame, we noted a break below a local swing low, confirming the start of the pullback. Typically, during a pullback, we identify a supply zone located at the extreme. However, in this case, there was no valid extreme supply zone. The only valid supply zone was this one, which happened to align with the Fibonacci Golden Zone, increasing the probability of a successful trade. We patiently waited for the price to pull back and retest the supply zone, providing an opportunity to execute our sell orders. The price subsequently dropped, respecting our setup. Returning to the higher time frame, we observed that the price reached our target. Additionally, the price retested our extreme demand zone. However, since this was a higher time frame demand zone, we refrained from executing trades at this level. Instead, we transitioned to a smaller time frame for additional confirmation. On this time frame, we waited for the price to break above a local swing point. As this was a continuation setup, We utilize the Fibonacci Golden Zone to refine our entry. Once the price pulled back to retest the Golden Zone, we executed our buy orders, and the price surged upward, reaching our target. And that's it. In this example, we successfully caught both the pullback and the continuation setup within a single 3-phase run. By applying the principles we've discussed, using the order block and Fibonacci Golden Zone in the right contexts, we were able to maximize our opportunities and execute high probability trades. The key takeaway here is to always align your strategy with the current market structure and the phase it's in. Whether it's identifying a pullback for short-term sells or riding the continuation for long-term buys, understanding when and how to use each tool is what sets you apart as a trader. Thank you for watching, and as always, if you found value in this video, make sure to like, comment, and subscribe for more trading insights. Stay disciplined, and I'll see you in the next video.